This evening, Clinton and Peter with you. 1332 is our number. If you have property questions, Peter is your man to answer them this evening. 1332, and you can email the program as well, tue.com.au. Peter Esho, good evening.
Good evening, Clinton. Good evening, everybody.
Huge week in property, especially with what happened last Tuesday when the Reserve Bank announced a cut to the official cash rate of 0.25%. But then, as we saw, the four major banks did not pass on that cut in full.
That's exactly right. And you and I spoke about this last week. We ended off last week's program by me saying that I thought the chance of a cut was very, very strong. We saw that cut, and saw an almost immediate reaction from the banks. It's very rare for the banks to come out on the same day, but now the last few cuts, they've been coming out on the same day and basically saying that they're only passing on a portion, and that portion is becoming less and less.
Yeah.
The value of that portion is really falling. And what we saw from Westpac was a discrimination between those borrowers paying interest and principal and borrowers paying interest only. So not only are they now gouging, they're starting to discriminate who they gouge from. And while the direction of interest rates is very important for property investors, I think the impact of a cut is becoming less and less in the market.
I've got no doubt about that. And I think you only have to look at how most owner-occupiers now react when there is an interest rate cut. Most of us, I know I'm in this boat, my repayment doesn't change. Now, it can if I ask the bank, but I keep it at that level. So effectively, I'm paying more on my mortgage. I'm starting to dig into that principal, which is what I want. But it means that from a stimulus point of view, and that's what the RBA wants, they want to stimulate the economy. There's not extra actual cash in my pocket to go out there and spend and stimulate.
Exactly. One of the benefits that we had on the way down of interest rates is Australia is very different to the United States, for example, because a lot more of our mortgages are on variable rates.
Yes.
And in the US, they have longer rates, 30-year rates fixed for 30 years. So
where really here, your maximum is going to be 5, isn't it?
That's right. We don't really have what's called a long-dated bond market, so 5 years sort of the longest you have on a home loan. But what happened is rates have basically plateaued based on pricing of what the majors are offering. So even before the two most recent cuts, rates were about 4%. Give or take. A little bit below, a little bit above, depending on your circumstance. And that hasn't really changed, despite 50 basis points of cuts since May from the Reserve Bank. So people are starting to think, okay, well, what's the point? You know, if my mortgage isn't drastically dropping, what's the point of cutting rates? And I think that's a big question that not only the central bank in Australia is facing, but central banks right around the world.
The tools of monetary policy are not as effective as they were 20 years ago, even 10 years ago. We've seen a very much a different way governments are now reacting to the markets post-GFC.
You're absolutely right. And people say, how low can they go? They can actually go negative, and they've gone negative in Europe and in Japan.
Here, though,
it won't happen here. Well, never say never, but it won't. It's very unlikely to happen here. But even in Japan,
the RBA still has that buffer, though. If they really need to act,
they can go a bit more aggressive, even though we're at an all-time low. But what we've seen in Japan and Europe is that even if it goes negative, it has a very minimal impact. And I think there's a big case now right around the world for governments to step in and pick up the slack. Monetary policy, interest rates are one tool. The government's ability to spend is really another tool. And I think there's a big case growing, and I think this time next year we're going to see governments right around the world spending a lot more money to stimulate the economy.
The question is, what effect does this interest rate cut have on our listeners, have on property buyers and people thinking of selling their properties? Now, the impact, whether this was the impact straight away on the market over the weekend, was interesting because there was a clearance rate at auctions of more than 80%. Which is higher than it was at this time last year.
That's correct. One thing I will notice is that there's less stock on the market. So we haven't seen a flood of property come on and a high clearance rate. So the clearance rate did bounce higher, which is expected.
Do you think that's off the back of the interest rate decision?
I think that helps because what happened is for most of the beginning of the year, many investors and owner-occupiers were thinking, rates are really low. Will they go up? Will they go down? In May, they came down, and now they're going down again. So people are of the view, okay, we're not going to stress about interest rates going up. And if they really want that property, they're going to chase it, which means they're going to turn up to the auction and bid. That's why the clearance rate is high. but the amount of stock on market is also not as high.
Very interesting point there, and the Daily Telegraph highlighted this issue today, and they highlighted some quite common suburbs, Mossman, Newtown, Cronulla. They pointed out in Manly, for instance, there are only 5 detached houses, so your good old Aussie-style home. There are currently 5 in Manly on the market. DY, so a little further up the beaches, 6.
It's very tight because people are asking themselves two things. First of all, if you sell, where do you go? Because the market's still strong. So if you sell, you need to find something else to buy or something else to rent. And people are of the view that, if I have to reinvest in the market, other areas have gone up and it's quite competitive. The second thing is that when interest rates fall, there's a little bit less urgency, there's a little bit less pain from forced sellers.
Right,
so people might hold on. They have that thought, you know what, I might hang on.
So not as many people are suspected of defaulting on their mortgages.
Exactly.
The bank doesn't have to step in and have a fire sale.
100%. The banks are given a little bit more time. And that's the whole point of cutting rates, right? You want to stimulate the economy. You want to provide some stimulus out there.
Yeah. If you're in the market for a home at the moment, that just makes it even tougher. So not only are we dealing with relatively high property prices in Sydney, there's not a lot of choice when it comes to it with freestanding homes in some of those peak suburbs.
That's right. I think it comes down to... We spoke to Simon Cohen last week at the top of the show from Cohen Handler, and he knows the Sydney market very, very intimately. And he made an excellent point, and I dwelled on it during the week, and I completely agree. It's that high-quality property is still rare.
Yeah.
The vulnerabilities in the market are those that are not high quality at the moment, and the market for those types of properties has cooled substantially.
What's your definition of a high quality property? We're not just talking a really nice Caesar stone bench top, are we?
No, for an investor, awesome question, Clinton. For an investor, basically, I'll drill it down to one thing. You want to buy an investment that has the ability to grow its income. So you want to buy a property, for example, that's returning $500 a week rent, for example, but you have a high degree of certainty that $500 a week rent can become $1,000 a year rent in 10 years' time.
Yeah, growth.
That's a high-quality asset, something that the income is growing, not going backwards.